A flower garland may look like a simple gift to a nightclub performer, but in Singapore, incorrect declarations involving these garlands have resulted in more than $6.8 million in taxes and penalties. According to IRAS, action has been taken against 8 nightclubs since 2021. The issue is not whether the flowers themselves are expensive. It is how the money collected from customers is recorded and taxed. At some nightclubs, customers purchase garlands to publicly show appreciation for performers. A part of the payment may later be given to the performer. Some garlands can cost $500 or more. In an earlier court case, prices reportedly ranged from $50 to as much as $100,000. Here is where the tax treatment becomes important. IRAS generally views the nightclub as the business providing the service. The club sets the prices, collects the payment, and decides how the proceeds are divided. This means the customer is not treated as simply buying flowers or giving a voluntary tip. The payment is part of the entertainment experience offered by the nightclub. GST therefore applies to the full amount paid. For example, suppose a customer pays $500. The club keeps $300 and gives $200 to the performer. GST is still calculated on the entire $500, not only the portion kept by the club. The full sale must also be recorded as the nightclub's business revenue. The amount paid to the performer may then qualify as a business expense. That distinction matters because recording only the club's share would make its income appear smaller than the actual value of the transaction. IRAS said some establishments had attempted to split garland income across different business entities operating from the same premises. A separate company might be listed as receiving the garland revenue, even though the nightclub continues to control the operation. IRAS may regard such arrangements as tax evasion when there is no genuine commercial reason, and the purpose is only to reduce taxable income or avoid GST registration. There is another layer involving overseas performers. Non-resident performers are classified as public entertainers. Their salaries and share of garland sales are generally subject to a 15% withholding tax. The nightclub must file and pay this tax to IRAS by the 15th day of the second month after payment is made. This case carries a broader lesson for businesses beyond the nightlife industry. Changing the label attached to a payment does not necessarily change what it is for tax purposes. Authorities will examine who controls the transaction, who provides the service, and where the money actually goes. Proper documents are also crucial. Businesses must be able to support their declarations when IRAS conducts a risk-based audit. The penalties imposed on these 8 nightclubs show that informal sales practices can create serious financial consequences when large sums are involved. In my view, enforcement is justified when businesses deliberately hide revenue. However, tax rules should also be explained clearly, especially in industries where commissions, tips, and shared payments can easily be confused. Do you think businesses should receive stronger guidance before penalties are imposed? Or is the responsibility already clear enough? Share your thoughts below and support 2230 by liking, sharing, and subscribing.